I think I'm lucky to work very closely with both Suhas and Manish, and I know Kunal obviously for a while now. So it is a great pleasure, and thank you to all of you to have come here. I know it's very hot, and you have come out of your good offices, so really appreciate it. First of all, that you are spending time with all the budding entrepreneurs. And it is also important to just absorb the journey that they have. Of course, we are going to talk about the term sheets and everything else, though that becomes very technical to a certain extent. What I intend to do is to bring the experience that Suhas, Manish have, and obviously Kunal in terms of how he approaches from a technical perspective. The idea here is to learn from their experience. The idea is to absorb, and the idea is to understand that how someone reaches what they have. My first on my left is Manish Bhandari, who is a serial entrepreneur, if I can say that. He used to run a company called Senna, and he does not remember. I do remember while I was at Persistent, I first met with him, and I distinctly remember, because our banker had introduced us to Manish. And when we started Legal Logic, we got reconnected and have been since very closely working on something or the other. The good part about Manish is that he is not just an entrepreneur looking at the mirror all the time. He is also extremely big giver, and he's been contributing to the ecosystem. He used to run a program from IIM Ahmedabad, and very successfully run that program. And now he is running a company called GrowthPal, which is into investment banking, and more obviously Manish will talk. Manish, thank you again. Thank you so much.
Thanks, Vivek. And Purva, I'm so glad to be finally here. I'd been feeling guilty of not making it, and I think we just spoke a couple of days back, and I think timing also just worked out. In fact, he knows, and I'll say it publicly. So I myself dealing with a term sheet. Hopefully, I'll be getting one next week. So so it's not just talking from the investors or the banker side. Also, as an entrepreneur, I myself dealing with that too. So thanks, Vivek. And so I'm actually very fortunate that I was an entrepreneur for about 12 years, and then sold my company, and then was very actively investing in startups for almost 10 years. And last 2 years, I'm now back as an entrepreneur. And this time, we're trying to disrupt the way investment banking industry works, which is kind of a crossroads between entrepreneurs, investors, and the corporate world. So yeah, that's so I'm really happy to be here.
Thanks, Manish, and we will talk to Manish and get more out of him. And to his left is Suhas Bakshi, and he's been CEO for a number of years before he launched himself into a very successful company now called Biofuel. And this company effectively started in COVID times, and it will be great to hear from Suhas in terms of his journey, moving from an industry where he had a it's easy to say comfortable life, but relatively comfortable life than what he today has. But he has in short time created a venture. He of course has run through term sheets as Biofuel, and is actively pursuing this venture after having spent, as I said, CEOs of marquee companies including Penar Group, Triple Point, where he was a director. He is an independent director at Praj. So he is a multifaceted personality. So Suhas, thank you again for coming here. I really appreciate it.
Absolute pleasure to be here, and thank you for inviting. This is it's always a pleasure to speak with people post lunch. It gives you an opportunity to probably wake them up and keep yourself awake. While before we get started with the actual topic, for me, entrepreneurship is relatively recent, but not so recent, because when you run corporations, you are an entrepreneur. You're probably taking risk on somebody else's money, but you're still taking risk. And once you turn yourself into an entrepreneur, certain perspectives change. And for me, they have changed. Prior to starting my journey in 2020 as founder promoter for Biofuel Circle, for 17 years, I was CEO of 4 different companies running their businesses in Asia Pacific. Fairly large portfolios. We acquired companies, we got acquired ourselves. So term sheet is not new. Uh, what do you look at a term sheet for as a buyer and as a seller, as an investor, is something which probably has provided me with different dimensions of experience. Would love to talk about it during the course of next 1 hour. uh, One of the things which I have probably learned uh, while running businesses in whichever role, is to look at the what is good for your business as the primary purpose for whatever you do with that business. And term sheet is the manifestation of that, because you sign term sheet for your business, whether you're acquiring one or whether you're getting acquired or whether you're getting invested into or investing into one. And I think looking at things from the health of that business is the primary objective. A lot of times individuals look at it from a point of view of what is in it for me. And I think that's the differentiation that I would love to explore while we talk over the next 1 hour. Thank you.
No, amazing. I think, these are golden words, and believe you me, we'll have a great discussion. And on my right hand is Kunal. Many of you possibly know him. He is company secretary and a teacher, Kunal, if I can say so. And, he is all over the place talking, and, he's built quite formidable reputation in the short period of time. Uh, he's been practicing for more than 7 years now. And Kunal, thank you for coming, and hope to learn from you as we speak today.
Yeah, this is special for me in terms of when I was, at your age, at 20, I had visited Mr. Vivek at his office at Persistent for career guidance. And today, sitting next to him, I really feel accomplished in a very small way. And second is, I think I bring 3 perspectives to this discussion from a term sheet perspective. One is, I have been acting as an angel investor since 3 years, and looking at a term sheet from an investor is completely different when you're approaching a term sheet in terms of advising a client, or when you're looking at a term sheet from advising an investor. So I've been on both sides of the table and an investor myself, and I'll try to bring in those experiences, because what I've seen typically happens is founders come from very technical backgrounds, and whenever they see tag along, drag along, any technical legalese, they immediately just push it to me, absolve themselves of responsibility. So today, language should not be a barrier, or the legalese should not be a barrier. You're trying to make it as easy, as simplified for all of you. So yeah, I'm happy to be here.
Yeah, thank you. Thank you, Kunal. And what we are going to do is, obviously, this is going to be interactive all through. We will leave some time open for you to ask questions. And as Kunal said, language is not a barrier in a literal sense as well. My all panelists understand Hindi, Marathi, and English. These 3 languages, and I'm sure they may have more languages too, but I won't understand, so I would restrict it to Marathi, Hindi, and English. So feel free to ask questions. This is a great opportunity as well as we look at. Let me start with Manish first. With so much diverse experience, Manish, and now that you are a banker, it's a full circle for you essentially. How do you look at a startup who's just on the verge of getting investment? They've started the process. The term sheet is just awaited. Um, what happens this time, right? I mean, this is the most exciting, but it's very anxious moments, right? You about to get the term sheet and you don't know if it's an IC meeting, what's happening, and just run us through that.
Sure, sure. So I think you should be very proud as a if you are a first time entrepreneur and you are raising the money for the first time. If you reach the stage of pitching to a few investors, so when you said I see it, then I'm assuming that this is you're pitching to VCs, the rather the institutional investors. If it's angels, then generally there's no IC involved. It's just that individual who kind of um, buys into your vision and your credibility and is willing to go ahead. But yeah, there is a lot of excitement, obviously, that at the same time, I would say that now that I've been in those shoes few times, I also look at it as a liability that okay, now I'll be taking somebody else's money and I have to kind of obviously do justice to it, and it's no longer just me doing what I want to do, right? So what I mean to say is that we need to take it with a bit of responsibility, and not it's not like okay, I'm going to get money and now I'm just going to rule the world, right? So and I think it's also time to probably reflect and start figuring out what things you would do maybe differently, right? Like for example, since whenever I've taken investment from investors, a good practice is to start giving them updates every month, right? Now today, when you have not raised money, you don't have to give updates to anybody, right? And for that matter, you don't even need to necessarily look at your numbers on the first of the next month, that okay, what happened last month. Sometimes you may look at it a month later, right? So I think just reflecting on some of those things is also a good thing to do, and not taking away all the excitement. But Suhas, you want to add anything?
Suhas, any thoughts on this?
I fully agree with what Manish said. Money is not the end. Money is the means to the end, and you cannot lose sight of what's the end that you're working on. So, getting money is, having the tools in hand. They need to be. It needs to be used effectively. Second, it's extremely important to get digressed the moment you have money. So, responsibility becomes extremely important. And
Do you do furniture first, or do you do business development
yeah,
first?
absolutely yes. And even in business development, do I do advertisement first or do I acquire customer first?
Sure, right.
So a lot of these things do matter.
No, so Suhas, staying with you, you have effectively again completed the circle. So it must have been very easy for you to raise money. Any thoughts?
My gray hair is a disadvantage. If I have to pose as an entrepreneur running a startup, because normally it is expected that somebody who has a startup is a young 20-year-old or a 25-year-old who has a lot of enthusiasm, and it is assumed that people in their 50s do not have enthusiasm. So I think there is almost every age at which you get into the startup world, you do have to counter certain what I would call as certain expectation biases, and so I still have to take care of some of these
To
biases.
do what I did, I took two co-founders who are 18 years younger to me. So
Unfortunately or fortunately for me, my co-founders are also in their 40s. So
Right. So let me turn to Kunal, and Kunal, can you explain to everyone what was the comment that Manish made, that the investment is actually a liability? Why is that so? And why is Suhas saying that this comes with so much of responsibility? Can you just decipher that in a non-legal manner for our friends?
One of the key reasons all of us have chosen the path of entrepreneurship, even I chose, was the variety it brings in terms of the number of customers you can solve, problems you can solve, customers you can meet, and the freedom with which you can operate, the flexibility part of it. We'll all love it as entrepreneurs. The moment you raise funding, or even before you raise, there are certain fundamental shifts mentally you need to make. Number one is, I can honestly say today, handling these companies, some of the companies which are private unlisted companies, normal private limited companies which have raised funds, they are MIS. So they submit, like Manish ji said, they submit a report to the investor, because the investor sets milestones whenever you raise investment, right? For each tranche that you receive, there is a milestone. So if it's a technology company, number of app downloads, turnover in revenue, new colleges onboarded, something like that. And every entrepreneur I sit with, when that MIS is prepared, the presentation is prepared, it's a very stressful atmosphere. And so I think the first pre-term sheet mindset is, are you ready to be that responsible? Are you ready to measure all these important metrics? And are you ready to become a little more organized? Because I've seen a lot of entrepreneurs running large companies not knowing, say, the basic metrics which are key to their business. So I think this is the first mindset. And second is, I think the first comment that came, which was beautiful, it's really not about you anymore. That is the second change that happens. The company has to run through a process. It has to run through a team. And once the term sheet is effective, right, it's not a binding document unless an SHA or something is executed. But the moment you have some third party on board, your business, you need to be redundant to your business. So are you okay with doing that also? Because I've seen most entrepreneurs are the horses themselves rather than a jockey on top of a horse. So I think these are the two fundamental shifts. You need to get clarity before you approach a term sheet.
Can I add something?
Please, Suhas.
So I think the point that you make is a very, very interesting point, because look, in the end, what is business? And is business as an entity independent of you?
Yes.
Now, somewhere down the line, because I came from running businesses for more than 30 years, you know, me being independent of business is a view that was inherent to the companies that I started. I think getting this fundamentally ingrained in you, that company is an independent legal entity with an ability to grow with, without, during, and after you, is the mindset that you need to bring in. And once you do that, then you create systems and processes which run that organization. And MIS is a fundamental process. It's a little bit like you going to the doctor every month or every 3 months and checking, what are your health indicators. So health indicators for business are important in good times and in bad times, because they give you a direction for the future.
So I have slightly different take on this. So I agree that one has to, you have to start building processes, and you have to start reducing dependencies on yourself. At the same time, I believe in the early stages of business, and perhaps at least the 2-3 rounds of funding, if you get to that stage, that you'll end up taking, you'll still be seen as the horse, right? And the reason I want to say this is that I've seen entrepreneurs where they start thinking that, oh, I can't do sales, so I'm going to hire somebody to do sales. I can't do marketing, I'll hire somebody to do that, right? I'll hire this, I'll hire that. Doesn't work like that, right? You have to be that one person, or as a founding team, who's going to run the show, right? And just because you've gotten money doesn't mean you just hire a bunch of people and now you are just an advisor to the business, right? You have, for the next 3, 4, 5 years, whether you like it or not, you will have to be that horse which is driving the rest of the bandwagon, right? But I get the point that you have to start building things and delegating and getting other people to come up to speed and start taking on more responsibilities and kind of to an extent slowly start becoming redundant on kind of certain functions. But
no, I completely agree with you. But, I don't think I would ever say that abandon in the process of so I'll give you a quick example. What do I mean by building systems and processes? Almost every organization needs customers. Now, is my customer relationship driven by information and data that I use out of the business that I do with these customers, so that I give better services to the customers, or through my gut feeling as the numero uno of what I am doing. Now, this is where you start differentiating and making sure that for building scale, it's extremely important that you build processes.
Absolutely.
Okay, very interesting. Let me turn to Manish and ask him as to what does investor look at when they put a term sheet. What are the top 5 things that they would look at putting in a term sheet? And from a founder's perspective, therefore, what he should be careful about. So, can you play both because you've been on both sides? How does an investor look at? And as Kunal said, is drastically different. And how does a founder look at when you have a term sheet?
So I'll give my perspective, but I think the top 5, you and Kunal probably
No,
better
I'm not
suited
asking
to
technical,
list.
but I'm saying that as a psyche,
Yeah,
when you have a term sheet,
Correct.
when you as an investor are giving, and when you as a founder are receiving,
Yep.
what's the psyche? What are the
Correct.
things that bother you?
Yeah.
Is this the cap table? Is this dilution? Is this valuation? Leave the terms aside for a minute, but just those aspects.
So I'll start with a very basic kind of theme behind it, right? So most good investors, and there are always some investors who have very different perspective, but most reasonable and good investors, their perspective is, if you are doing well, if the business is doing reasonably well, they don't want to come in the way. They want to let you keep going, right? And therefore and these things reflect in the terms, right? But in the event that you're not doing well, right, and it could be for multiple reasons, that the business is just in certain market conditions, etc., that is not doing well. It could be that you as a team are not executing well. It could be you as a founding team are having too many conflicts, and things are going haywire, right? But for whatever reasons, if business is not doing well, then they want to have enough controls in place through the term sheet that they can maneuver things, right? So I think this is a very fundamental thing that you all need to understand, that why do investors put certain things in the term sheet, right? It's not that they're just being very greedy and they don't want to take any risk, and therefore they're putting like everything as per what's in their favor, right? It's really what is in the business's favor. And to that extent, you as an entrepreneur are also shareholder of the same business, right? So you have to really look at it from that perspective, that investors probably have a lot more experience, and the term sheet is sort of reflecting that. Now, this applies to, let's say, if you're 3 co-founders, and one of you start behaving in a very bad way, right? Now, whatever happens is going to impact 2 of you as well, right? So if the investors have pushed for certain terms which allows them to take certain actions, then it's in everybody's interest, right? So that's not to decipher the term sheet, but I felt that this is a very important thing that most first-time entrepreneurs, especially in the first time they're raising funds, they kind of miss out, and they really start thinking, oh, we are 2 sides of the table, and we are really like the kind of the opposites of each other, and what they're going to ask is not in my favor, what I'm going to ask is not in their favor. That's not the case, right? Most terms are, I think, generally reasonable. Any comments on this before I continue on the thread?
No, keep going.
Okay, so the second point I would make is that most of the time we entrepreneurs get stuck up on the valuation, right? Because we think that that's the, if we get the the highest valuation, ho gaya hamara kaam, right? Rest of the things are okay. And that's not the case. Everything is in a kind of a package, right? And the valuation obviously depends on lots of different factors, and just somehow trying to get the highest valuation is not necessarily also in your interest. Like, I'll tell you a few examples. A lot of times, not a lot of times, I think one of the clause that every term sheet is going to have is liquidity preference, right? And let's say the valuation you've gotten somehow is the investor is putting in $1 million, and you've gotten $5 million post money, so 20% stake you're diluting, right? And let's say the investor was offering more 3 million, and you somehow got them to do 5 million, right? They'll still put a lot of maybe more aggressive terms in the, say, liquidity preference, or they may put very high return expectation and IRR. I'm sure Kunal and Vivek will decipher those terms for you. And sometimes they will put such rigid terms that will make it a lot more difficult for you to raise the next round, right? And that next round they'll put has to be at least 3x of that valuation. Otherwise, you have to give me more equity, etc., etc., right? So just valuation as a one metric to pursue is also not advisable. You have to really look at the entire set of terms and see, what investors would probably feel comfortable with, right? And what kind of growth and market that you can achieve. And I personally always look at whether it's for my own company or when I'm investing in a company as an angel, I always look at how is the next round going to happen. And I'm going with the assumption that the company is going to require at least one more round of funding, right? And for that round to happen, what are the set of milestones which are expected? And is this money and this team going to be able to deliver that or not, right? If not, then that's a big challenge to face right away, right? And if you are going to be able to meet that milestone, what is the likelihood of based on the market multiples of that valuation, right? And if I'm already pushing my current round valuation close to that, then it's unlikely that I'll be able to get that, investors excited for the next round, right? So valuation has lots of other kind of issues attached with it, challenges associated with it, and that's where the other terms come into play too. I'll just take a pause and
let me reflect on what Manish just said with an example. Of course, can't take names here, but this is an IoT company in Pune which took money at a serious valuation. Today they are at a point where because of the cap table issues and the valuation as the biggest, the focus on valuation versus focus on value were something where there was a big mismatch. And today the company is in a situation where because of those legacy valuations they're not able to break, which otherwise possibly, again it's all in the hindsight, you can make a judgment, but possibly they would have been far better if they had not chased valuation in the beginning. Now, what are the ways and means of breaking that? One is you have now convertible note which is coming out, and I'm going to ask Kunal to talk a little more on that in a minute. But let me just first go to Suhas and ask Suhas, do you want to say more, anything more? Okay. Let me ask Suhas. Suhas, you have now recently looked at a term sheet. When the term sheet comes, what should founder look at? What should he do when he receives the term sheet? And uh, just I'm sure you understand all of that. But even to get term sheet, there's a lot of work that goes on. There's a lot of work that goes on to get the term sheet. Term sheet is just the start, but you have run really, really fast. And then when you see a term sheet which is loaded with some language which you or someone in your team is not familiar with, it can get daunting. In that event, having done so well to reach a stage where you now have a term sheet which you all looked at, what do you do, Suhas, as a founder?
So I think, I will probably qualify my response to be for an early stage company, right? For an early stage company, it's extremely important that investment comes from investors who are investing on account of the trust that they have in the founding team as well as the business model. And it may not be trust, it may be it may be hope in the idea, it could be belief in the team or whatever. I think some of these are fundamental drivers to the success of your business. And if the term sheet reflects that, I would take that as being right for the future of the company. But if somewhere down the line the term sheet has clauses which may impact the business strategy in a negative way, the business business, ability to take right decisions for the business in a fundamental way, then I would look at that uh, as a point of discussion to understand whether it comes from a position of extreme mistrust or it comes from a position of having doubts, and how do we discuss those and come to common understanding on that. I think that would be fundamental for me. For me, valuation, value, a lot of these things are important, but the first and foremost is, why is somebody investing, and is that investment going to be good for taking this combined idea forward, because they become a stakeholders in your idea from the day you take their investment, so you're together from there. So that would be fundamental for
If I
me.
could just continue on that. Yeah, I think that's a very, very good point. That kind of couple of things here. One is that most term sheets have clause on the various controls, right? And if somebody is putting such tight controls that you'll not be able to run, right? For every small thing you have to go to investor and ask for permission, then that shows they don't really trust in the team, right? And that is a big negative. And what I said earlier, that controls are put for the right reasons, then they need to be reasonable, right? That if somebody is doing mischief, they're doing fraud things, those are generally enough legal language to cover those. But if it goes way beyond that, and somebody is trying to chain you with every possible thing, then that's a big negative, right? Yeah, I would agree with that.
So, Kunal, as a professional, how do you prepare a founder when he receives a term sheet, or he's just about to receive a term sheet? How do you prepare? Because that preparation is an important element in terms of how you actually play the real match, right? I think the training, the preparation. So, can you just give a glimpse of what preparations you as a professional would do with your founder?
Okay, I'll just share my 2 cents on the earlier question and then go to this. I've raised about 44 funding assignments for my clients. The lowest one was 10 lakhs and the highest one was about $24 million, about 215 crores. What I've realized is investors, what they look into a startup is very contextual. There are certain investors who are playing the spray and pray policy. They will invest small sums of money in multiple startups, and there they are just liking the founder or liking the business model, don't really go into depth, and they're just expecting a decently good performance. The milestones are also relaxed. But the moment it gets into a VC or an institutional fund, what they start looking becomes very objective. All the liking part, all the subjectivity part, abstract part completely goes out. So in all these deals that I've done, I've seen 4 common elements that investors becomes a deal breaker, yes or no kind of a thing. Number one is always, are you yourself invested in the company as a founder? Invested as in not money wise, but effort wise, survey wise, market research wise, experimentation wise. Are you actually maxed out, right, from your intellectual and family and friends capacity? So they really look at that. So if you're yourself slacking, investor won't come in front. Second is, have you achieved some sort of an MVP, basic minimum viable product, some critical mass, or are you a talker? So a lot of my time is wasted these days, and I don't know how to deal with it, because I really love listening to pitches that people all are all projection talks, right? Numbers are also projection. So investors really, have given me this comment so many times that, Kunal, legal due diligence is one thing. We really need to do a actual, work due diligence also, whether they have the requisite thing to even sit across the table. The third thing, and I think this is the most important, what investors look at, are you a cultural fit with the investor? So certain investors who have made a lot of money and are retired now basically just want people to hear their advice. They want to be on the boards, they want to be important to the startup. And if the founder is not a person who listens a lot, even though the money comes through the company, the cultural issue will cause a lot of issues. And there have been cases where the founder had to buy back the shares from the investor because the marriage was not working out. It is a marriage, right? You spend so much time with your investors. And I think these are the top 3 ones, what an investor looks. Coming to now, how do I prepare founders? So I usually do a simulation exercise where I, along with some of my professional colleagues, we sit as a panel and we grill the investor from a very third party perspective on basically to ascertain just one thing, because this is the fourth point which I missed sharing, which I'll share now. Investors are always looking for an answer to this question, that is money really going to solve your problem of scaling up or wherever you are, or is it going to be something else? So as long as you can tell the investor, as long as the founder is ready to give an answer that yes, I have figured the business model out, my product market fit is good, basically the business is running and I'm getting too many orders, and I now need money either to R&D and come out with a better product or take the product to more people, the investors really won't get convinced. So as long as we as professionals and get convinced on these 3-4 metrics, we are good. We also always say that a term sheet typically is not a binding document. Nobody is going to hold you against it. It will just serve as a reference piece for a larger, more detailed document later. So lot of people, because I think the social validation you get from funding is so beautiful and it looks great on social media, they don't look at clauses. Or there have been cases where I have put comments, this is a deal breaker, don't sign the sheet, but yeah, the founder signs it. So not knowing, we say in our legal field, ignorantia non excusa. So you can't plead ignorance, you can't say that I didn't know what this meant. Or
So how do you prepare? Meaning, you as a professional obviously know that there are pitfalls. So how do you prepare someone who is expecting a term sheet?
Once I think the mindset shift that I spoke about in the first answer, is he really ready for it? I do talk to him about a lot of things that he will have to now do in addition to what he was already doing. I will take him through all the clauses and tell him that just because you receive a term sheet from a lead investor does not mean it is a sacrosanct, unchangeable document. So I think I create a mindset of the entrepreneur where he's going in expecting a win-win rather than, I just get the check kind of a thing.
Sure. No, that's an excellent one. I think this win-win is important. It's not just looking at the mirror and the social media validation, as Kunal said. And also very important is the fact that funding is not the end of your journey, right? It's actually a start of it. It's a liability. Why is that called liability? Because it sits on the balance sheet and you're responsible for it. It doesn't come in your asset. The cash comes in your asset, but the real entry is on your capital account. So from and I see quite young faces here, those who will start or they're about to start. Remember that if you approach your business only from a funding perspective, most of the times we see that people don't get to that particular stage because you're so overly dependent. If you're dependent on money and if you don't get it, then your venture is going to not even go the distance. So therefore it is important to understand as to why this money business is become such a big social situation. But can you live without that? And if you cannot, you must make sure that you have at least 4 or 5 sources before you actually launch yourself. Otherwise there are expectations mismatch, and we're going to talk about that expectation mismatch after Manish makes his comment.
I was just going to make a quick one that one of the things that I personally do a lot is doing a lot of modeling that, okay, if I'm taking X amount of money, then what am I going to do with it, right? And what kind of milestones am I going to be able to hit with that, right? And I'm not going to look at hitting 10 different diverse milestones. I'm going to focus on, if I had choice of only one, what is that one thing I'm going to crack with this money? Right? And then maybe the second thing I would crack with this money, right? So am I going to be able to hit the product market fit, right? Am I going to be able to fix the team issue that I have, right? That the people are expecting a certain kind of team and I need a certain kind of team to be able to do certain things. So I'm going to pick a couple of things and then do that modeling and see how this money is going to help. And because I think like one of the gentlemen here said that you are going to, as part of any fundraise, you're going to agree upon certain milestones with the investors, right? And having too many vague milestones is not going to cut it, because you're going to run into a lot of surprises. There, a lot of things you can't predict. So it's better to be very focused on what is that one or two things I'm really going to change with this money, right? And doing enough numbers, kind of modeling with that is what I would prepare before I get the term sheet.
This is excellent. This is excellent, Manish. Thank you so much. Let me ask Suhas, from your perspective as a founder, when you receive a term sheet, what are non-negotiable? Again, I hate this word non-negotiable. That's more a lawyer word. Uh, but from your perspective, right? So integrity is non-negotiable, as we call that. The question is more from that standpoint. What are some things which are non-negotiable from a founder's perspective? That of course, money is important, but it has to be on even terms, and therefore these things are non-negotiable from a founder's standpoint. And again, you could give a general answer, you could give an answer which is specific to you.
So, before I give you my own perspective on what is non-negotiable, I'll give you a real life example that I faced while I was not an entrepreneur. I used to run a German engineering company called DMAG, and DMAG is founded in 1819, and so it's a 203-year-old company. And they've gone through the Industrial Revolution, and they've gone through 2 world wars, and they've gone through the Nazification of Germany, and everything that came along with it. So very, very long history. And I was responsible for setting up business in Asia Pacific, and part of it was to set up a factory in India, and also part of it was to acquire one large Asian company. Okay. Two things happened during the process of doing these two important or achieving these two important milestones, which have stayed with me forever as experience. One is, in India, when you build a factory, almost everybody buys land. Okay, so if you go and tell an Indian entrepreneur who's setting up a manufacturing company, saying, you can't buy land, he'll look at you and he'll say, what the hell are you telling me? Land is an ever-growing asset, and you have to buy land and construct a building. Yeah, even IT companies did that, right? So I was in my own world thinking that this is a given and it will be approved by the board. My first proposal to the board was rejected. My second proposal to the board was rejected, and I said, what the hell? This is what we agreed, right? So why is the board rejecting the proposal? And the third time I spoke to the group CFO, I said, what the hell is happening? And he said, Suhas, we are at 200, at the time we were not 200, we were 190-year-old. So we are a 190-year-old company, and one thing which we have learned through all of this is we will never invest in bricks and stones anywhere in the world. Okay, now for me, this was a shocker. But the question is, this was to me a definition of red line. In a way, the company in India was a subsidiary company. I was taking investment from the parent company, and the parent company had drawn a red line and clearly said, everything is fine. We want to do this. This is our strategy, but we're not going to invest if it is going to be in bricks and stones. If you're going to create IP, if we are going to be running businesses, if we are going to set up manufacturing technology-based assets, yes, we are investing, not in making a building and buying land. So I think this is one lesson that I have carried in terms of saying what is the value and ethics that I bring to the table as an entrepreneur, as a businessman, as an investor, whatever, and what is it that I would not agree for. And what is it that my business would not agree for? The same company, DMAG, we were acquiring a Bombay-based company. This was, in 2007, when you were spending 500 crores to acquire a manufacturing company, it was big money. Okay, and as a part of routine, as due diligence, one due diligence was environmental due diligence, and the environmental due diligence resulted in. So this company that we were acquiring was next to factory of a tire company. The tire company used to historically put in the effluent in the nalla which was next to the factory, and thus the water had seeped into the water table, and the water table under the land where the factory was the was adulterated water table, right? For a German company, this would have meant millions or billions in damages if their shareholders or rights groups around the world would come to know as to what you've done. For an Indian company, acquiring this asset would have been a great leap forward. This was one reason why we did not acquire that company. So to me, the definition of what is red line and what is non-negotiable thus has been permanently etched based on what is my value system. And if there is something which is which is asking me to negotiate with my value system, I think that would be non-negotiable. Everything else, I think I'm willing to negotiate.
This is an amazing answer, and I wanted that answer, Suhas. I think one thing that I have learned is everything in life is negotiable when it comes to commerce, right? When it's a commercial dialogue, business dialogue. But what is non-negotiable is what Suhas just mentioned. Thank you so much, Suhas. That's an amazing answer. And I come from a company. I learned my whole thing from Persistent Systems. And that's one of the most ethical companies that I have seen. And I can completely relate to what Suhas is saying as to what is non-negotiable. So that's great. Kunal, coming to you, what are the best practices while you review a term sheet for your client?
So once the client is okay in certain aspects where he's negotiable, he's okay, and there are certain places where he's put a hard stop. I think negotiation starts from there, because you spoke about expectation management, and I have been lucky that way, that in some cases I've represented both. So a client of mine invested in another client of mine. So in this cases, what I've usually realized is everybody wants a win-win kind of a proposal, and term sheets also are nothing other than the understanding that they both have put on paper. There have been cases where, because of too many people involvement or too many professionals advising, things have taken a long time, the due diligence has taken a long time. But more or less, once the founder and the investor is clear as to what they want out of it, that the term sheet gets through very fast. And that's why I often struggle with first timers, first time founders and first time investors, because everything is seen with a cloud of doubt, whereas the people who are doing it routinely know exactly where to see, what to see. Founders know exactly which clauses to give away, which clauses to stay on. So I think again, just like I said, what the investor looks and what a founder wants from a particular term sheet is very contextual, but overall these 3-4 things.
And Kunal, one thing that I do is to request my client. You can only do request, is to not Google and come to me, because that completely dilutes because the context.
Learning from doctors.
And it is not advisable. Of course, Google helps you, no doubt about that. But then when you make a hard opinion because you read something somewhere, that context is completely different. So when you come to someone like us, you need to make sure that you have an open mind. One of the most critical aspect of learning is open mind. And while if you're doing it first time on the term sheet or these investments, remember that the investor is possibly a professional one. The person who has money has a little better experience than the others, is what is the usual wisdom. And when that person is doing that for his living and he is expecting a return, and nothing wrong with that expectation, you have to guard yourself with a open mind to make sure that you are not faulting in the first place itself by making a hard stand and taking a hard stand that no, this is not something that I'm going to agree to, or this is okay to agree to. Both those things, that I'm not going to do it or I'm going to do it in this manner. Then how you look at a person like Kunal or me who's advising, you of course are paying. Remember that you're paying us, but you don't get the value that you are actually looking at. So there's an art And Suhas, I admire him because we work with him. His ability to extract the best out of a professional is something that it comes obviously with an experience, and it comes with a lot of time to be spent. And there's a reason why he has gray hair. You have to make sure that you ask relevant questions and then make your mind, rather than make your mind and then ask questions. I think if you take this from today's session, I'll be that'll be an awesome thing to do for all of you.
I can add one point here. I remember there was this graduate from Harvard. He'd done his master's in law from Harvard, and it created a AI-based database for tracking civil cases and all of that. And he was raising his first round. When he came to us for consultancy, I was pretty overwhelmed, right, looking at his CV, and he was 18 years into the profession, like double of my experience. And what he told me stays with me. We were in Mumbai at the hotel, and just before the investor could come in, and I genuinely asked him that, you have raised money in your previous company. You seem to be definitely more qualified, more experienced than me. What is it that you want me to add? Because I will definitely try my best. And his answer was very good, and I think this applies to all founders. He said, whenever it's your own company, there is a emotional involvement and a bias towards your own company, and you cannot look at it from a vantage point which any third party can give. So in our case, I think especially when we deal as firms, right, not as employees of the company, our actual motive is to get you the best deal, and not really any ulterior motive, ulterior interest. And in that deal also, I think couple of points that we could suggest to him really helped him in the deal and how it's moving forward. So I think that third party neutral vantage point advice becomes very critical. And just like Mr. Sagle said, we are there to help. So that becomes critical.
Sure. We're just touching our time. Let me, Manish, please. No, please.
Running short of time.
No, please go ahead.
I just wanted to that value system that Suhas you talked about, and so I was just trying to think that, okay, how do you put that in action, right? And so one advice I would give is that when you're talking to, especially when you're talking to an institutional investor, and when we talk about term sheet, generally means that you're getting it from an institutional investor. It's very important to understand who is that person, who is that individual who's going to sit on your board, right? Because it's not that VC firm that you are taking money from. It's that individual who's going to sit on your board is going to largely influence how you run your business and how flexible they are, or what is the value system and all of that, right? And it's difficult to measure value system of a firm, right? It's far easier to measure value system of an individual, right? Unless the firms are well established, 20, 30, 40 years, and you can, do that. So always find out that a lot of times you would talk to an associate level person, you'll have 4, 5, 6 calls, and then finally you get to pitch to the partner. And then ultimately it's that partner who's going to sit on your board, or maybe somebody else, right? So finding that out, who that person is, making sure you connect with that person, you align on the value system, and they are, that person is comfortable with you. That is very important.
Question to you, Manish. My last question, and then we'll open up, is when there is a gap in terms of the valuation, the expectation from an investor, he's said X, and the founders ask is 1.5x. How do you bridge that gap?
Okay, I think that's an easy one. So one side of it is that do you have multiple investors lined up, right? And so, which means that you have something really great going, and there are enough people interested in investing in you, right? If you have that, if you have enough interest, then you can negotiate better, right? If all you have is one investor who is willing to give you a term sheet, then, but that doesn't mean that you give up, right? So there, what you can do is, if let's say, investor is, I'm just going to pull big numbers, right? Investor is giving you $3 million valuation, and you are asking for 4.5, right? Then one way to do it is you agree upon, there is a this legal term called clawback. So let's say they so that at 3 million, let's say you are ending up giving 15% of the company, and at 4.5 million, it would have been 10%. The math probably won't match. I'm just picking up numbers, right? Then there is a way to negotiate that if I hit certain milestone could be in the form of revenue, or it could be in the form of next round funding, right? The next round funding, meaning that if it's at a 3x or 4x valuation of today's funding, right? A lot of investors will be willing to allow clawback, which means today you, Mr. or Miss Investor, take 15%, but if I hit these milestones, you give me back 3% or 5%, right? And I think a lot of investors are willing to do that.
All right. So
Rather than getting stuck up and just kind of keep negotiating, because a lot of times when you negotiate too hard, it's not giving a good, vibes to the other side, right?
Right.
So,
right. Let me open this up for questions. Feel free to ask questions, and you must ask questions.
I have a question on their behalf. When they don't ask question, I have questions on their behalf. So one question that I have is for the early stage investors, where there's a mistake that happens in the first deal, because as Kunal was saying, that you are doing it for the first time, and there's a mistake that happens in terms of the term sheet. So the angel is there, and the company is there, and then you get to the next level where there is a serious business that really happens from the investment perspective. How can that correction really happen? Because that mistake has happened in terms of diluting a lot of stakes to somebody who's an angel, and then you want to kind of retract and get back into the normal business, and this is where the gyan comes to you. Oh, I've made a big mistake now. How does this really happen in reality?
I've seen cases where I was an investor.
I am actually asking from the experience that I have.
This happens, and so it really is that if the investor is reasonable, they are going to agree to correction, and a lot of times it gets forced by the next investor. Right, so the new incoming investor is going to see the cap table and saying like, why is this person holding 40% of the company at this stage, right?
Yeah, right?
And they'll tell the founders that you take half of it back, or I'm not coming in. Right? Now, if that angel or whoever that is going to play very hard ball, ultimately founder will have to tell him or her that if you are not willing to do it, then I can't raise money. Then I'm going to shut down.
Sure,
right?
Sure.
Ultimately, it's all negotiation. But most, so as a group of angels, I would recall at least maybe 3 times that we had to cut our holding because the founders ended up raising multiple rounds, and then in the eventual round, the founder was holding 2 less in equity, and the incoming investor said, "I'll come in only if the existing investors take a haircut." So the term for it is haircut, right?
Absolutely,
And
absolutely.
so yeah, but then the thing is that it all depends on how your relationship is with that investor, right?
The first one,
right? For any investor, actually, for that
Yeah.
matter, right? You should always build that relationship. It's not paisa aa gaya now, fine, or looking at it saying, you're sitting on the other side of the table. No, right? For that legal agreement, maybe you're sitting on the other side, but otherwise you're on the same side. Both of you are holding equity. Right? So
sure.
I can add to this. So I typically work in early stage and Series A. And what happens that initially it's a friend or family or a trust-based investment. Even in the valuation question that was earlier asked, when a lot of my deals couldn't go through, the valuation, because of the valuation issue, I understood 2 main problems that used to happen. One is, because it's all projection, it's very negotiable. So I think getting some numbers on the books and make it at least half data, half projection really takes the valuation forward. Second is, I think becoming conservative on your growth percentages and very optimistic on your expenses will give you a better bargaining power, because the investor can't say anything then, right? You've already taken care of that. That being said, I think first, why people go wrong in their first investment is it's not really a structured investment. It's more of a negotiated investment. And this automatically gets corrected in the next round, because if it's a VC firm or any other, the kind of professionals they hire in the due diligence itself, we make sure that either a new company is formed altogether as an SPV, and everything is done in the new company, leaving the old aside, or we get everything done from scratch. So I think the people who are the basic, I think solution to this is, even if it is your friend, even if it is somebody you know who's supporting you, try to take the investment through a systematic, objective, a professional, advice driven approach, and not as a negotiation approach. So if you do that and keep it objective, it will be okay.
Actually, I want to highlight something Suhas had said earlier, that make sure that the incoming investor is bought into your vision and has that high hopes in this business, right? It is extremely key, and I want to highlight it, especially when you're taking the first initial investment, including from friends, family, or people who are not professional investors, right? The investors who are coming in because they really believe that this idea and what you're doing has a very, very high potential. At the same time, they're very, very willing to lose that money, right? They are going to invest in 20 companies, and they know that 5, 6, 10 out of these may die, right? So they're prepared to lose that money.
Sure.
There are other class of investors who are more conventional investors, right? So I'll give an example. People who are generally have invested in land, right? So they see, okay, I buy this land and every year I get 20-30%
Absolutely.
increase, right?
Yeah.
That mindset is
And
going to
real
run into
estate.
lots of issues, right? Now, if
Real
such a person, you ended up giving 40%, God help you from getting even an inch back, right?
Yeah,
Because
right.
they are just not that kind of investor, right?
Absolutely. I agree with you. That is the problem in the market today, because they want returns the way you get it in a real estate market. That's not how
So
startups
the
really
due
work.
diligence should not just be done by the investor, should be done by the founder also. And you may not be in a frame of mind in an early stage. You welcome all kind of money which is coming
Absolutely,
in,
because there's push
but
toward, there's no money there, and that
I
is
think
where
it's
you mistake.
it's important to and I know that giving this advice is easy. Actually implementing it is always difficult, but you should still give that advice.
Absolutely agree with you. Great, fantastic. I think it was a great interaction. Any question? Someone? Yeah, there.
Hello, can you hear me?
Yes.
Thank you. I have a basic question regarding the funding and the very early stage startups, the students who are sitting here, have their ideas and everything, and the Shark Tank is going on reality show, which is so every person who is having idea and they're feeling like that, they are real sharks. They will eat your business and they will grab everything and they will run away. So how come this mindset needs to get changed, that person, the marriage which Kunal says that it needs to be in a win-win situation needs to be there. That is my question. Is Thank you.
I think that's a brilliant question, because if there is an investor who's posing as a know-all, who's posing as somebody who is always going to be looking over your shoulders and telling you what is a right thing to do, what is a better thing to do, the question that you will ask is he the friend that I want to have? And I think that's an important part of your own due diligence. I think even if I'm a 20-year-old, 21-year-old, fresh graduate out of university, I have seen my professors, I have seen students, I have seen people who take advantage of me and people with whom I get along well. So the question to be asked is this the right chemistry? And so who was your project partner in the last year of your college? Who worked well with you? What type of people am I able to do well with? Will this bring out the best in me? Will this bring out the best because at that time you are the company. So I think a lot of these things are important. And somebody used the phrase marriage, right? You don't say yes to the first proposal that came your way just because you're all excited about getting married. I think it's there is a process which goes on in your mind. So be yourself. There is no need to get overawed by the type of personality and the type of overtures or barricades that the guy may put in front of you. Be yourself.
Just remember that that's a show, right?
I
And
was gonna
it's
say.
Absolutely.
its primary purpose is TRPs. All right. So I don't watch it.
No. I do
And-
understand, but my question is, whenever you're looking at the Shark Tank India, Shark Tank US, something like that, it ultimately आपके mind में जाके कुछ ना कुछ it will start
So my
doing some
experience,
chemistry
99%
for the new people as well.
my experience, 99% investors are not like that. They don't behave in that manner. And kind of using the term shark is kind of little far-fetched there, stretched
So-
there. But yeah.
I handle 2 startups which have been invested by sharks, the 3, Ashni, 3 of them. And whatever we have worked with them so far, they're really not interested in taking over or even interfering. A call happens every month. They want to know the progress on the milestones each one sets, and that's about it. I think the first answer was pretty good, and the simple solution to that is what you don't want in an investor. If that is clear, I think then the marriage or the cultural fit will work well. What you don't want, I think that clarity should be there.
Thank you.
Great, fantastic. You could
Is
have
that
wound
all?
up.
And I think we just on top of the hour, and
Yeah.
let me thank all 3 of my panelists, first for coming, second for sharing, and third for not making you sleep. So all 3 achieved. Suhas, Manish, Kunal, thank you so much.